Hey everyone, and welcome. Today, we're jumping into one of the most wild, most explosive events in all of finance, the short squeeze. It's this incredible phenomenon where the very act of betting against a company can, paradoxically, cause its stock to absolutely rocket to the moon. It turns all the normal market logic completely upside down.
Really, at its heart is this beautiful paradox. A short squeeze is what happens when a massive bet on a company's failure backfires so spectacularly that it actually lights the fuse on a financial rocket ship. And once that fuse is lit, the stock price just soars in this powerful, chaotic, and often violent feedback loop.
And look, you've definitely heard about this with GameStop, right? That whole David versus Goliath story where an army of online investors took on these massive Wall Street giants and just caused absolute mayhem. Well, that was a short squeeze in its purest, most modern form. And today, we're going to pull back the curtain and break down exactly how that and other famous squeezes actually work. All right, so Section 1. What is a short squeeze? To really get the squeeze, you first have to understand the move that sets the whole stage. It's called a short sale, and it's basically a bet that a stock's price is going to go down. Okay, so here's how a typical short sale works. Let's say you're an investor, and you think a company's stock is way overvalued. So you go to a broker and you borrow shares of that stock. Then you immediately sell those borrowed shares on the open market. Now you're just waiting, hoping the price drops like you predicted. And if you're right, and it does drop, you buy the shares back at that new lower price, return them to the lender, and you get to keep the difference as your profit. Simple enough, right? But what happens if you're wrong? What if the stock goes up?
Well, that is the squeeze. When the price starts rising instead of falling, those short sellers are suddenly losing money. And here's the scary part, their potential losses are literally infinite. So to stop the bleeding, they're forced to buy back the shares they owe, but now at a much higher price. All this frantic buying from people who are betting against the stock creates a vicious feedback loop, and that's what sends the stock price into the stratosphere.
So Section 2, the anatomy of a squeeze. A short squeeze isn't just some random event. No, it's more like a recipe. It requires a very specific and usually a very volatile set of ingredients to come together to create the perfect financial storm.
And it really all comes down to these three ingredients. First, you need the fuel. That's a high short interest, which just means a whole lot of people are betting against the stock. Second, you need a spark. This is some kind of catalyst, like unexpected good news about the company. And third, you've got to fan the flames. As the price rises and losses mount, brokers start making margin calls. They demand the short sellers either put up more money or be forced to buy back shares immediately. And that forced buying, that's what truly ignites the explosion.
So there's this key number that traders get obsessed with. It's called days to cover. And it basically tells you how many days it would take for all the short sellers to buy back their shares and get out of their bets based on the stock's normal trading volume. When that number gets high, say over 10, it's like a crowded theater with only one tiny little exit. It's a huge red flag that if things go wrong, the short sellers are going to get trapped. Now here's where it gets interesting. Knowing these ingredients exist, some investors don't just sit around and wait for a squeeze to happen, they actively try to trigger one. So let's look at how the game is played from both sides. You really see two main ways investors play this. On one hand, you have the patient turtle approach. This is where you quietly buy into a heavily shorted company that you think is actually a good business, and you just wait. Then, you've got the aggressive rocket approach, which is exactly what we saw with GameStop. That's a direct, coordinated assault where a group of buyers bands together with the explicit goal of forcing the short sellers to surrender. But let's be super clear here. This is an incredibly high-risk game of financial chicken. That massive price surge you see during a squeeze, it's totally artificial. It's not driven by the company's real value. It's driven by that forced buying. And once all the short sellers have finally covered their positions, the buying pressure completely vanishes and the price almost always comes crashing back down just as fast as it went up.
And while things like social media have definitely amplified these events, the short squeeze is anything but new. This stuff has been a feature of the markets for well over a century.
Seriously, this has been happening for ages. All the way back in 1901, a battle over a railroad triggered a full-blown market panic. In 1923, the founder of the Piggly Wiggly supermarkets brilliantly squeezed the very investors who were betting against his company. But two of the most famous examples of all time happened much more recently. Volkswagen in 2008, and, of course, the one that changed the game, GameStop in 2021. So let's look at that Volkswagen squeeze from 2008. This one was wild. See, the car company Porsche had been secretly, quietly buying up almost all of VW's available stock. When they finally revealed their position, the short sellers just panicked. There were almost no shares left on the market for them to buy back. The result? The stock price exploded over 400% in just 2 days, briefly making a car company the most valuable corporation on the entire planet.
But the GameStop situation was, if it's even possible, even crazier. So many big hedge funds had bet against the company that the short interest reached 140% of the public float. That's the total number of shares actually available for trading. Just let that sink in for a second. More shares had been borrowed and sold short than actually existed on the open market. It was a ticking time bomb.
So, the GameStop event wasn't just some crazy story the traders told. It was bigger than that. It exposed some really deep cracks in the plumbing of our financial system, and it raised these fundamental questions about fairness and manipulation in the modern age.
And this is where things get really tricky. This is the central question that regulators are wrestling with right now. When millions of individual people on social media all get together and coordinate to buy a stock, is that a new form of democratic collective action, or is it just illegal market manipulation no different than what Wall Street giants have been accused of doing for decades?
Well, the fallout from GameStop has forced this huge, ongoing debate. Regulators are now looking at absolutely everything: the role social media plays, the incredibly controversial decision by some brokers to just halt buying, the immense strain that was put on the system's back end, and whether all of us just need a much clearer picture of who is shorting what stock and when. And all of that leaves us with one final crucial question. GameStop proved that a decentralized army of passionate individuals connected online can actually take on the most powerful institutions on Wall Street and win, at least for a little while. So in this new digital age where information and influence travel at the speed of light, it really forces us to ask, has the balance of power in the market shifted for good?